Hello and welcome to Out and Out Trader, where we break down all the news, narratives, facts and figures that matter this week, giving you a critical edge to your trading heading into this week's market action. In this week's Narrative versus Reality, we look at Russia's strengthening currency and break down the dynamics of why that does not equate to economic strength for the country. In news to watch this week, we take a look at Australian housing and the data that suggests a potential peak and crash is imminent. Highlights on the economic calendar this week include the PBOC interest rate decision, where we will be looking for signs China is beginning to weaken its currency in order to deal with the effects of a slowing economy. And we finish off with a look at the charts and our trade of the week, which is the Aussie dollar yen short. So let's get into it. At the outbreak of the war, we saw the Russian ruble plummet, losing over half its value in just over a week. But since then, we've seen an unexpected rebound in the currency, having strengthened to 5-year highs against the euro and pre-pandemic levels against the dollar as of this week. This unexpected strength has left Russian supporters in awe of the strength and robustness of their currency, and the Western world wondering if the so-called sanctions have had any effect at all. In reality, the strengthening of the currency is nothing more than balance of trade and capital flow dynamics as a result of Russia's own counter-attempt to minimize the effects of Western sanctions. As of the onset of the infamous special military operation, Russia's imports have plummeted while the world's dependency on Russian oil and gas has remained steadfast and even increased as a result of shortages and supply chain issues. Despite the sanctions, the EU still pays Russia about 640 million euros per day for oil and around 360 million euros for piped natural gas. Meanwhile, the goods and services Russia could and usually would import using these funds has dried up, leaving it with a bank account that is overflowing with cash, but very limited places to spend that money. In addition, Russia's ramped up interest rates to 20% and severely restricted local businesses, banks and citizens from selling or exchanging rubles for other currencies, and as a result, inflation is soaring and the economy is now set to shrink by 12% this year alone, the worst economic contraction in over 30 years as reported by Bloomberg. Russian stocks remain over 40% down from pre-war highs, and ostracism from the West is starting to mean fewer buyers for Russian exports. And should oil prices tumble due to global recession, which as we expect they might, the ruble will struggle once again moving forward. In our last episode of Out and Out Trader, we detailed the cracks forming in the very overheated Canadian housing market as a result of rising interest rates and a weakening overall economy. Today we shift our attention to Australia, where things seem to be equally as fragile as reported by Bloomberg this week, saying that Australia's housing market faces its biggest test in over 30 years. As we've been warning for some time now, the supply constraints caused by COVID lockdowns have pushed prices to levels that now bring the demand side of the equation into play. Supply constraints have led to a dramatic increase in prices, which has left the global consumer questioning the affordability of everyday goods and brought the strength of the global economy into question. Many Australian property investors remain in denial with the belief that house prices always go up despite record year-on-year increases in the past year. Today we want to break down the logic that indicates a decline in house prices is highly likely and investors should exercise caution moving forward. The general equation is that as interest rates rise, the affordability of debt becomes a problem unless real wages can keep up with the increase of the monthly payments of such debt. For example, a 1% rise in mortgage rates would see a new borrower in Sydney facing a rise in average monthly mortgage costs of around $486. And if we see a 2% rise in rates, the same buyer would face an additional $1,005 in monthly mortgage payments. Without an equivalent increase in wages, the investor is left out of pocket for that amount, which puts pressure on the investor to spend less in the economy at best and offload their property at worst, which is often the case for those who bought their property for investment purposes. At this point, we begin to see a spiral in house prices as an influx of investment properties come to market at the same time that demand for housing is cooling. What we see in Australia's case is that real wages have been declining drastically since 2008, as rather than solving the issues that led to the global financial crisis in the first place, governments around the globe chose to kick the can down the road by implementing poor and misguided policies that essentially paint over the cracks of the real issues at hand. One of those issues is record levels of household debt to GDP, which exacerbates the problem of debt affordability when an inevitable economic slowdown comes into play. With a high level of household debt, the share of monthly income needed to pay for these debts increases exponentially as rates rise. In Australia's case, household debt to GDP levels are currently sitting at over 220%, well above the 150% danger zone that led to a housing crisis in the US and many other parts of the world in 2008. This suggests the level of household debt is indeed a major issue and leaves the property market primed for a shock should a catalyst present itself. The catalyst seems to have arrived in the form of inflation, which now sits at 5.1%, the highest it's been since 2008, leaving the Reserve Bank of Australia with little choice but to begin hiking interest rates. These unexpected rate hikes have led to rapid ascent in mortgage rates over the past few months, with little sign of slowing, while at the same time the rising cost of goods is putting pressure on consumers, leaving the affordability of these mortgages increasingly strained and consumer confidence at levels last seen during the beginnings of the COVID pandemic and the 2008 financial crisis. The first signs we begin to see of a potential slowdown come in the form of a number of mortgages being applied for. As the consumer comes under increasing pressure, the desire to take on new debt begins to drop, and what this translates to is fewer buyers coming to the market. This lack of demand creates downward pressure on house prices, which can lead to a rush for the exit for current homeowners, especially those who bought property as an investment, who suddenly find that their current rental income is incrementally covering less and less of the costs of owning the property. This also follows the rule of thumb that we've mentioned in previous episodes, which is when house prices begin to increase by over 10% per year, it indicates that the housing market is overextended, which historically leads to negative year-on-year house price growth in the following years. Current yearly increases in Australia amount to 24% overall, well above the 10% rule of thumb, with the Brisbane area exceeding 30% year-on-year growth, well in excess of what is considered a housing bubble. Worryingly, we've already seen these dynamics begin to play out in Canada, as previously discussed, and we are also seeing the same trend in New Zealand, with house prices already down over 10% in Auckland and Wellington. The coming global recession, as outlined in previous episodes, seems to be accelerating and will start to add further pressure on the Australian consumer, which will likely exacerbate the problems we've outlined in this episode. So it goes without saying, in the current market, buyers beware. All that being said, if you're looking for a place to park your money through the coming turmoil, our investor guidance service will help you do just that. We're currently running a special offer on annual memberships, and you can find the details in the link below. In the economic calendar this week, we have China retail sales out on Monday. We'll be having a look at how much damage their COVID-0 policy has done to their economy. On Tuesday, we have UK unemployment, Euro GDP, and US retail sales. US retail sales, a big number for us, as we want to see if that global recession is starting to hit the US consumer, which is a major driver of the global economy, obviously. Then Wednesday, we have Japanese GDP and UK Canadian CPI. Thursday, we have Australian unemployment, obviously a big number in terms of what we're going to be expecting moving forward with the housing market. If unemployment starts to peak up, that's obviously going to be a big driver in a negative direction of everything we've just outlined in this episode. And then Friday, we have the PBOC interest rate decision. We'll be looking for the PBOC to start cutting rates. We've already seen them started to weaken their currency. They need to supply some stimulus into their economy after the devastating effects of their COVID policies and everything they've done to prevent COVID in their country. So we'll be watching for that. In this week's Trade of the Week, we are sticking to the Aussie dollar theme and looking for a short in the Aussie dollar Japanese yen. Obviously, if the global recession starts to peak up, global currencies will be running towards more safe haven flows, and there's no better representation of that than the Aussie dollar yen. If we suspect that the Aussie dollar is going to fall against the yen, it's an indication that risk is coming off the market, and that's exactly what we saw if you look at 2007 to 2009, a big drop in the Aussie dollar versus the yen as those currencies flowed back into safe haven currencies like the yen. And as we've been saying, I believe the yen is going to retake its place as a reserve, as a safe haven currency moving forward. And that's what I believe we've started to see over the last few the last few days. When we go into the weekly chart, we can see how over the past few weeks we've been in a little bit of a downtrend. Basically, the past month has been in a downtrend. We had this nice high pin candle to start it off, and we've had some good follow through since then. When we go even further down into the daily charts, we can see how it's a nice big move to the downside, already down off those highs, a good 6%. Saw a little bit of a rebound into Friday's session, but I suspect that's just temporary moves. We might see a bounce into this kind of 90.45 region, a little bit of a corrective move in there, and then a continuation of that moving forward, with eventually our overall targets going back down to, as we mentioned, those 2008, 2009 levels, and beyond the March 2020 levels that we saw pre-COVID. So you can expect sub 60 moving forward. Now it's just a matter of finding a good entry into this trade and seeing if we can start to run into those profits moving into this week and beyond that. So Aussie dollar yen short, a definite must trade for us this week, and something we'll be keeping a close eye on, especially the other yen pairs. We also like Canadian yen. As we mentioned, the Canadian housing market also seems to be ahead of the Aussie market in terms of the price declines, and we can expect the same thing there. And then New Zealand dollar yen is another one. These commodity pairs against the yen should start to take a hit as that global recession comes into play and commodity prices start to roll over. So keep an eye on that. And that's it for today's episode. Please like and subscribe if you enjoyed the videos. Members, we'll see you in the members area for a outline into the markets this week, the FX, commodities and crypto update and game plan for the week. If you would like to join as a trader and start to take your financial future into your own hands in a much more active way, you can find more details in the link below. We'll be also running specials on the Trading Academy, yearly subscriptions, so please check that out. Cool guys, hope you have a great week. Members, we'll see you in a bit.